In 1976, a man launched a fund built on a radical idea: stop trying to beat the market and just own all of it. Wall Street laughed. They called it un-American. They called it Bogle's Folly. Today that one idea controls trillions, and it quietly won. Here's how badly the laughers were wrong. That first index fund raised just over $11 million, a fraction of the $150 million it had hoped for. Today the company Jack Bogle built sits on more than $10 trillion in assets. The Folly became the foundation. The idea sounds almost too simple to matter. Instead of paying an expert to pick winning stocks, you buy a tiny slice of every company at once, and you do it for almost nothing. No genius, no crystal ball, just the whole market at the lowest possible cost. Bogle's whole philosophy fit into one brutal sentence. Don't look for the needle in the haystack, he said. Just buy the haystack. Stop guessing which company wins. Own all of them, and let the market do the work. This is the story of how that one stubborn idea humbled the smartest people on Wall Street, why the fees they charged were quietly eating your retirement, and how index investing became the default way America builds wealth. Let's get into it. To understand why this was heresy, you have to understand what everyone believed in 1976. The whole industry was built on one promise: pay us, and we'll beat the market for you. Bogle went back to the data and asked a heretical question. Did paying for expertise actually pay off? The answer, decade after decade, was damning. Over any 20-year stretch, roughly 9 out of 10 actively managed U.S. stock funds failed to beat their simple index benchmark. Not some years, most funds, almost all the time. Why? It's not that the managers are stupid. Many are brilliant. It's arithmetic. As a group, all investors together own the whole market, so as a group they earn exactly the market's return. The moment you add fees and trading costs, the average active investor must, by simple math, end up behind. Even the greatest stock picker who ever lived agrees. Warren Buffett has told ordinary investors, again and again, that the smartest thing most of them can do is just buy a low-cost index fund, and that he's instructed his own estate to do exactly that. Buffett believed it so completely he bet $1 million on it. In 2007, he wagered that a plain S&P 500 index fund would beat a hand-picked basket of elite hedge funds over 10 years. It wasn't close. The index returned around 7% a year, the hedge funds about 2%. So if active managers usually lose, how much does trying and failing actually cost you? The answer hides inside one tiny innocent-looking number: the fee. Look at the gap. A typical actively managed fund might charge around 1% a year. A broad index fund can charge as little as 0.03%. On the surface, both look like rounding errors. They are not. Watch what that fee does over a lifetime. Imagine you invest $10,000, add nothing more, and grow it at about 7% a year for 40 years. At a near-zero index fee, you'd end up around $149,000. The full power of compounding, almost untouched. Now run the exact same investment, the same returns, but with a 2% annual fee instead. Same market, same 40 years. You don't end with $149,000. You end with about $69,000. The fee quietly took roughly half your final nest egg. This is what Bogle meant by the tyranny of compounding costs. You took every dollar of the risk, every crash, every sleepless night. But because of fees, you walk away with a fraction of the reward. The system was rigged quietly by a single decimal point. But low fees alone don't explain it. The deeper reason Bogle could go this low was a second idea, even stranger than the first. He gave the company away. Every other fund company serves 2 sets of customers: the investors who put money in, and the outside shareholders who own the firm and want profits. Those 2 groups want opposite things. Lower fees help you and hurt the owners, so fees stay high. Bogle's solution was almost absurd. He structured Vanguard so the funds themselves own the company, which means the investors own it. There are no outside shareholders demanding a cut. When the firm makes money, it has only one place to send it: back to you, as lower fees. That structure created a one-way ratchet. With no outside owners to pay, costs only fall. The industry's average fund fee has collapsed from over 1% in 1990 to roughly a third of that today, and Bogle's price war is the single biggest reason why. And here's the part Bogle was proudest of. Because the firm is owned by its investors, no founder ever cashed out a fortune from it. Jack Bogle could have been one of the richest men in finance. He chose deliberately not to be. The savings went to ordinary people instead. For its first 20 years, the index fund was a rebel idea on the fringe. Then the dam broke, and once people saw the math, the money didn't trickle in. It stampeded. Look at the tipping point. For decades, active funds held the vast majority of stock fund money. Then, around 2019, index funds quietly passed them, crossing half of all U.S. stock fund assets for the first time. The fringe idea had become the majority, and the idea didn't stay one product. It spread into a whole ecosystem. The exchange-traded fund put an index in a wrapper you can trade like a stock. The target date fund put it on autopilot for retirement. And the robo-advisor wrapped indexing in an app. Same engine, 3 new bodies. And the scale today is staggering. Index funds and index tracking ETFs combined now hold well over $15 trillion in the United States alone. A product mocked at its birth now anchors the retirement of an entire generation. If you have a 401k, a workplace pension, or a simple retirement account, there's a very good chance Bogle's idea is already working for you. Silently, in the background, every single day, you're living inside the revolution. Before you treat this as a free lunch, you have to take the other side seriously, because the revolution that won so completely has created brand new problems of its own. Start with concentration. When everyone buys the whole market, 3 giant firms end up controlling most of it. Together, the 3 biggest index managers now own roughly 20% or more of the typical large US company, raising real questions about who actually controls corporate America. Second, an index isn't truly neutral. A standard index buys more of a company as its price rises, so when a handful of giant tech stocks balloon, the index quietly piles into them too. You think you own everything equally. You may actually own a concentrated bet on a few names. Bogle himself, the man who started it all, saw the danger before he died. If indexing kept growing without limit, he warned, the concentration of ownership in a few hands would not serve the national interest. The creator was uneasy about his own creation's success. This is the honest tension. The same idea that saved ordinary investors hundreds of billions in fees also handed unprecedented power to a tiny number of firms. The revolution worked, and working that well is now its own kind of risk. Strip away the trillions and the controversy, and ask the only question that matters for you. What does this 50-year experiment actually teach a regular person trying to build wealth? The first lesson is the hardest to accept. Trying to beat the market is, for almost everyone, a losing game. Not because you're not smart, but because the odds and the fees are stacked against you. Humility here is not weakness, it's an edge. The second lesson is what Bogle actually preached, and it fits on an index card. Costs matter, pay as little as you can. Diversify, own everything, not a few bets, and stay the course. Don't trade on fear or hype, boring, repeatable, and it quietly beats most professionals. Remember the prize, because it's enormous. The difference between a near zero fee and a 2% fee, across a lifetime of saving, can be roughly half your final nest egg. That's not a footnote. It may be the single most important number in your entire financial life. That's why they stopped laughing. Bogle's Folly didn't beat Wall Street by being smarter. It won by being cheaper, humbler, and almost impossibly patient. It proved that the most powerful move in investing is often to stop trying to be clever. If this finally made the index fund revolution click for you, do me a favor and follow Market Minute. Next time, I'll break down exactly how to build a simple, low-cost portfolio from scratch. I'll see you there.